All right, hello everybody. Thanks so much for taking some time to check out Aspen Sage and what we're working on. I'm excited to talk to you a little bit more about what we do, and I'll kind of go through some of our presentation. It's really about reducing risk in uncertain economic climates and conditions. Basically, we believe we are in an uncertain economic environment, and because of that, we really have to take a lot more focus onto protecting the capital, right? Capital preservation and risk management. And so I want to kind of go through or like to share with you some options that will help you preserve that capital that you've built over the last decade while everything has been going up, 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 and show you how you can have some long-term profits, stability, and flexibility even in a bad economy. And so, just a quick introduction about myself. And again, Brian Lochner. I'm married with two kids. Came from the financial software industry. Been full time in real estate since 2014. Ultimately, ended up speaking in the real estate space and doing some consulting, pretty heavy in the cryptocurrency space as well, and really focusing a lot more on creative finance, mortgage note strategies over the last several years. My business partner, Tiffany's been involved in real estate since 2006, also married, has some kids, and really done a collective of different strategies from short sales and tax liens and multifamily, a lot of residential stuff, and really started focusing heavily on the mortgage note strategy in 2017, which is really where we met. We happened to be consulting at for the same company in 2017. That's where we first met each other. She's helped over 1,000 people get into real estate and note investing. And really when we kind of reconnected on the note space is when we came up with this idea for a fund. And so our fund has a very unique focus for a very, what we consider to be a unique season in our economy. And it's really focusing on this diversified cross-sector approach that really highlights the capital preservation and risk management side of things. As the market shifts, we want to be able to shift as well. And with so many uncertain macroeconomic factors, large economic factors like inflation, preserving the capital that you work so hard for is really the primary goal. And we've been able to partner with some of our best relationships over the past 10, 15 years to help further increase deal flow as well reduce risk and bring more expert minds to the table. Our positioning is pretty straightforward. It's really an emphasis on real estate, secured both by multifamily, commercial, and the residential real estate side of things. Our main focus where we put capital is really in the residential real estate note space. It hedges against the larger economic conditions because we focus on buying discount mortgages that in bad economic times, they will go up in volume and pricing gets better. And so the worse things get, the more protected we become. These are all first position liens. These are seasoned performing notes that we're buying. People who have put a down payment down and maybe they've been living there for 2, 5, 10 years. We're also interested in buying non-performing notes, the main thing that increases in negative economic climates where that supply is going to increase, and we're able to acquire these notes at large discounts to further protect the investor's capital. We are really reducing regional risks as well by buying these notes across the country. And we happen to have a large network of individual note buyers to where we can buy large pools of notes and sell them off in smaller chunks, providing liquidity in a very illiquid marketplace known as real estate. Instead of tying up your capital for 5 or 10 years, without any opportunity to pull it out, we are able to turn these notes over occasionally, and that creates liquidity, which further protects the investor. We do have an interest in the commercial real estate side of things. We look at retail buildings that are leveraging national tenants that have corporately backed leases. So if one store goes out of business in a recession or something, they're corporately backed. Several of those actually happen to also be backed by banks. We are very interested in the multifamily space. It is really one of the last affordable housing options left in our country. And we're really looking at the B and the C class properties where we can add value, increase the rents to market rent over a 3 to 5 year hold time frame, which forces equity, protecting the investor capital, increase that cash flow, obviously, and then exiting. Our primary position is a diversified approach. Like I said, primarily in real estate, we do keep some liquidity, of course, but these discounted mortgage notes are our core focus. And then we are obviously investing in the multifamily and commercial. But our heavy focus right now, due to just the current market cycle where we're at and what we're seeing, is on these first position liens. We're looking at portfolios between $10 million and $30 million that are available. We've got some agreements to acquire up to $1 million per day. And due to our network, we have the liquidity of about $3 million a month that we can resell every single month to create, again, just that liquidity, that turning over of capital. And that puts us in a strong position to protect investors' capital regardless of market conditions. The performing and the non-performing note sides, not only do they create very predictable cash flow because they're mortgages, we know really right out of the gate exactly where we stand. But again, that large network of note buyers that we are continuously growing creates that liquidity in a very illiquid market. And so just a little bit about our performance and kind of how distributions are going to be made. We do distributions twice a year, August and February. Our next one is coming up August 31st, and then obviously February 28th. After that, minimum investment is $100,000. Fractional shares are allowed above that. We don't charge fees of any kind. This is one of the unique approaches with us is there's no withdrawal fees, there's no management fees, no acquisition fees for any of the deals that we're working on, subscription, disposition, penalty. There's no fees of any kind. And this is because we want you to have very predictable, stable income. Once you put money with us, you know exactly what you're going to make in the future. All of our compensation is based solely on performance. We don't make any money until you've fully received your investment, your earnings, and then we cover all the overhead, we cover all the fees, and then anything above that is really where we can start to make some money. We have two different classes of notes. The first note is a 6% note that is $100,000 to $250,000 investment, and our Class A note is $250,000 and up, but it produces a fixed 8% annual return for investors. Another unique thing about us is that your investment starts 24 hours after you invest with us. And that just means that you don't have to wait for us to find a deal. You don't have to wait for us to close on a deal. You're earning interest, and it's our responsibility to have that deal flow. And that's what we've been working so hard on over the last 5 to 10 years, is making sure that we have these opportunities. Withdrawals can be done really at any point in time. You know, the SEC has some preferences on this with a 12-month written notice because we are in real estate. But if we're able to pay out a little bit earlier and do withdrawals faster, we can. And this is due to our liquidity. This is one of the factors we added into the fund to ensure that we're positioning ourselves to be able to liquidate assets on a regular basis, monthly and quarterly, rather than being stuck in them and subject to any sort of economic shifts. Our core focus right now is we're raising $25 million again for these note portfolios. And we can acquire up to about $1 million a day of discounted mortgages currently through some of our relationships, but we are entertaining a larger portfolio. It does produce a little bit better quality as well as a lower risk for our investors, and so this is our core focus. And we're seeking relationships with accredited investors, family offices, relationships that are going to have somewhere between $250,000 to $5 million. And so if this is something that you are interested in, if you're interested in the capital preservation and the risk management approach, regardless of economic, conditions, whether it's good times or bad times, definitely feel free to reach out. We'd love to have a conversation with you. Our information is down there at the bottom, but basically to get started, it's as simple as going to www.nofees.fund and setting up a portal, and we'll allow you access, and that's kind of the first step. And so I look forward to answering any questions you might have or digging into any of the needs you have on how we can serve you. And we're excited to grow wealth together and ultimately get through any sort of economic shifts, leveraging this unique opportunity in real estate. We'll talk to you soon.